This next section I'm going to call behind the scenes. I'm going to give you 4 items to think about to help you better manage this whole process of finding, tracking, and handling red flags. Training. When training employees in the mortgage industry, it's crucial to recognize the diverse backgrounds of your employees and the different talents they bring to the table. Some loan officers are exceptionally diligent, adhering strictly to regulations and maintaining high ethical standards. They might not even consider the possibility of fraud, nor suspect others of such actions. On the other hand, some employees might be inherently suspicious, believing that fraud is common, it's everywhere, and they're always on the lookout. What this means for you is that what to check is a top-down decision, a management decision, and it's not left to the individuals within your organization to decide on their own. You establish clear, consistent guidelines and protocols that management can ensure that all employees, regardless of their personal inclinations, follow the same thorough process. This approach reduces the risk of oversight by overly trusting employees and curbs unnecessary suspicions by those who are overly cautious. Management-driven standards create a balanced, comprehensive framework for detecting and preventing loan defects, ensuring the integrity and reliability of the bank's operations. You collect lots of data on originators, borrowers, counterparties, and with this comes a wealth of information that can be harnessed to detect potential loan defects and fraud and ensure compliance with regulatory standards. For instance, consider default rates. A higher than average default rate can be a red flag for underlying loan quality issues. By examining these default rates in detail, institutions can identify specific originators or loan officers whose loans are defaulting at an unusual clip. This can prompt further investigation into their practices and the quality of the loans they're originating. Similarly, unusual loan origination patterns can be indicative of fraudulent behavior. For example, a sudden spike in loan volume from a previously inactive or low-producing originator may warrant closer scrutiny. Such a change in volume could suggest that the originator is now engaging in risky or fraudulent practices to boost their numbers. I'm in favor of tracking these anomalies down to the loan officer level, not just the originating broker. This approach allows for more precise accountability and helps in addressing the issues at their root. One client found a dramatic spike in volume of a construction to perm product. Great to have the volume, but the spike caught their attention. They found that the loans were the result of a builder recruiting straw buyers to pose as someone building their dream home. In truth, it was just the builder rounding up straw buyers and saying, hey, apply for this loan, say it's going to be your house, I'll use the proceeds and build a great house and sell it, and oh, by the way, here's $10,000. So a lender thinking they had a really nice bump in production was in fact holding the bag on a couple dozen loans with occupancy misrep. What a headache. By making good use of the data at their disposal, institutions can protect themselves from the financial and reputational damage caused by loan defects, ensuring a safer and more reliable lending environment. Where can you look to find threads to pull? That is, suspicious data points to investigate further. Let's talk about your loan servicing departments, which is, of course, the collector of payments. They have a lot of contact with your borrowers and hopefully good notes about those conversations. What red flags can you find in your servicing notes? Well, money laundering through accelerated payments is not uncommon. These are mortgage payments that are made with illicit funds, and as soon as the payments are made, that money is laundered. Accelerated payments over a year or longer allow large amounts of money to be laundered. In addition, notes taken by your servicing department often contain clues to various types of loan fraud, from admissions about occupancy misrep to statements about responsibility for making the payments. For example, one elderly borrower told the servicer that she wasn't responsible for making her payments, that she was behind on her payments, but someone had agreed with her that they would negotiate with the lender and see that she could get out of the trouble she was in. In fact, she was being scammed. So these little clues are found in your servicing notes, odd statements made to your payment department about who might be responsible and who might be living in the subject property. These are found then in your servicing notes. So any due diligence that you do about a given loan should include a review of your servicing notes. Next, in the commission-driven world of loan origination, the term grateful for the production reflects a mindset where the eagerness for business can overshadow the critical assessment of its quality. The gratitude for incoming business might lead originators to overlook potential loan defects, driven by the desire to close deals and earn commissions. While it's natural to appreciate a steady flow of business, it's essential to balance this gratitude with a diligent review process. Failing to do so can result in significant problems down the line, including repurchase demands, the rescission of mortgage insurance coverage, ultimately harming the bank's stability and reputation. To take prudent managerial steps, we first have to acknowledge this reality about the commission-driven business in which we live. All right, let me spend a little time on balancing customer interactions with underwriting realities. Establishing clear underwriting standards to loan applicants who may wish to bend the rules can be delicate. For example, a borrower might hear from a neighbor that they can buy a rental property with a low down payment, or wish to use their VA eligibility to purchase a rental condo at the beach. Loan officers face the challenge of educating without alienating these potential clients. If they appear too rigid or uninformed about possible loopholes, they risk losing the client's trust and business. It's essential to balance firmness with a customer-centric approach, ensuring compliance while maintaining these client relationships. The job of a loan officer is to sell and to educate at the same time. Borrowers can propose things that just can't be done, like using VA eligibility to buy a vacation home, or they can hear that interest rates are here when given their credit report, they should be there. Creatively shepherding customers can be a challenge. I saw one loan officer go ahead and sign what I will call redundant or unimportant disclosures for a borrower. He had an agreement with his client, the borrower, that he wouldn't trouble him for signatures on disclosures. It was taking a long time to close the file. And when it all closed, the lender found signatures that didn't match. When the lender asked the loan officer, what's going on here? The loan officer candidly just confessed, well, the borrower told me not to bother him with all of these signatures that were needed on the disclosures, so I was to go ahead and do it for him. Loan officers have to understand that when you do that, you create problems for the integrity of the data in a loan file, and you then might have a loan that is not of investment quality. Here's a loan officer trying to accommodate not bothering a customer, and instead they created a big problem for the lender. One of the important duties that you have under the Bank Secrecy Act is to file suspicious activity reports when you find activity that might be a violation of law or regulation. So in this section, we're going to cover some important information to help you get your feet underneath you when it comes to finding, writing, and reporting on suspicious activity. Sometimes you will find frauds that show obvious coaching by a sophisticated real estate agent or a lender. When you find this, you might have HR issues, you might have counterparty issues to deal with. So what I encourage you to do is set your P&Ps in such a manner that you know how to address these things before they come up. Simply put, you are obligated to resist the urge to not take action against Cheryl, because Cheryl is your biggest producer, broker, loan officer, correspondent. You've got to take action regardless of who you're taking action against. The first point that I want to make is that the quality of your SARs is important. Your board and your senior management will receive regular reports about the SARs that have been filed. They need not get copies of the individual SARs, but they'll certainly get an executive review on the number and nature of the reports. They're e-filed with FinCEN, And recently, regulators have expressed some concern about the quality and content of SARs. So to assist you in avoiding unfavorable reviews of your SARs, I want to spend a few minutes on a topic that might seem down in the weeds, but given how your SAR quality reflects on you, I think it's an important topic to discuss. First, I want to urge you to employ templates in the preparation of your suspicious activity reports. They increase quality, they reduce the time spent on preparing them, and they allow senior management to approve of the language that represents your institution to FinCEN. SARs written by various employees will necessarily contain a myriad of writing styles and content quality. So SAR templates solve this problem of style and quality with the added bonus that your board and your senior management will be able to approve the language that goes into your SARs. I'm a lawyer, and I'm very particular about my writing. I fight very hard to not have misspellings or errors of any kind in the things I write. When I was running my fraud investigation firm, IMARK, I had to figure out a way to have 1,000 fraud reports a month go out over my signature, and it was not possible for me to read 1,000 reports a month. And someone else's writing carrying my signature made me very nervous. So I solved that quality issue with the use of templates. Some may argue that the circumstances of each SAR are too varied to fit conveniently into a template, but I promise you that's not the case. We developed canned language to fit a dozen of the most common scenarios, virtually eliminating the inevitable errors that would occur without templates. We don't type notes or deeds by hand, nor should we prepare SARs by hand. Use templates. With a template, the sentences are complete, the spelling is correct, the narrative is presented in an orderly fashion, and it is important that proper language is used when reporting suspicious activity. I've seen badly written SARs state, quote, "We have proven that John lied about his income." The more accurate and legalistic sentence might have read, "Our investigation found that the pay stubs we relied upon when approving John's loan were materially false and misleading." That is the way to write the sentence. Take control of the content. Take control of your written English. Get it approved by management and use templates. In conclusion, the management of red flag reviews and potential suspicious activity is an important task for your institution. You have to assess your risks. And so how do you do that? It's by the type of business that you do, where you do it, the volume of business, who your counterparties are. These are things for you to assess based on your own business's footprint. Once you know your risks, you can then establish policies and procedures to handle those risks. Then you can put in practice the things needed to effectively run a department that's going to check the red flags to make sure that your company is not exposed to the financial or headline risk that's going to come with this kind of activity that could hurt you. And finally, when you need to write up suspicious activity, to do it in an organized fashion with templates that are management approved. Thank you.